Hey guys, this is DSCR Depot. I'm Matt, your guide to real estate investor financing. I want to talk to you guys today about DSCR loans, but keep in mind you can just go ahead right away and sign up at dscrdepot.com. That's where you're going to get any help evaluating your particular deal, introductions to different brokers that can help you with particular deals, just figuring out whether financing applies to your situation, and going over more complex structures with experts. Okay, so let's get into it. This channel is built for real estate investors who want to grow portfolios without being blocked by traditional lending rules. So we're breaking down DSCR loans in just clear, practical, step-by-step way. There's a lot of misinformation on the internet about DSCR loans and how to use them. They're fairly simple on face, but the complexities are in your particular deal, and that's where we can be helpful. But by the end of this video, you know exactly what a DSCR loan is, how they work, and how to determine if your deal qualifies. Let's start with the core idea behind DSCR lending. It stands for Debt Service Coverage Ratio, and the DSCR measures whether a property's income can cover its mortgage payment. If the property pays for itself, lenders are willing to finance it. It's that simple. Your personal income is not the deciding factor in this loan type, and that's the critical element. Here's the formula how we calculate it. Gross rent divided by monthly PITIA. And PITIA stands for principal, interest, taxes, insurance, and HOA fees. The PMI isn't really mentioned because the typical down payment on a DSCR loan is a standard 20%. Occasionally it's lower, and we can talk about that. So PMI is not going to be applicable on this type of business loan. So here's an example. You got a monthly rent of $2,000 of the property you're looking at, and you got a PITA of $1,700. So 2,000 divided by 1,700 is 1.18. That's your DSCR ratio. And a DSCR of 1.18 typically qualifies at most DSCR lenders. So let's discuss what lenders actually evaluate in DSCR underwriting. Looking at three primary things. Number one, the income of the property. Two, your credit score and your cash reserves. Number three. Okay, so notice what's missing. They're not evaluating your job income or your tax returns. There's no W-2s required. And this is great because even at high ends of income, for the percentage that can be applied to real estate, you're capped pretty quickly. You can go really as many properties as makes sense for your economic situation or what it makes economic sense for you. But on a W-2, on your personal credit, after a couple properties, it's going to get difficult. So no pay stubs required, no employment verification or length of employment. All of that out of the equation, just looking at those three factors. So this is one of the primary reasons DSCR loans are so powerful for investors. So let's talk about the credit score expectations. Generally you need a 620, that's the minimum, and you really want to have it above a 680. That's where you can get a decent rate and a competitive rate. And they further improve as you go up, a 700 and above, and etc. Above a 740, I think that's the limit. So anything above a 740 with most lenders, that's going to be getting you the best rate available with them. Now let's look at the down payment. It's usually 20 to 25%. If you have a particular deal that warrants a 10% payment, if it's a compelling deal or you're a larger investor, then we can talk about it. There are a few people that write those loans, but typically I think even if you're starting off with one or two investments, you want to strive to hit that 20% down payment. And if that's not economically feasible for you for the property you're looking at, you just need to find a different property. It's as simple as that, to where that number fits your budget. If you put more money down, your interest rate improves and your more likelihood of approval increases. So that's a controlling factor in the rate. Okay, it's going to be driven by that ratio, improving the ratio, and also your credit. Those two things are going to really drive the interest rate. So let's talk about the interest rates. They're higher than primary resident mortgages, and they're typically anchored to the 5-year Treasury note plus, 300 basis points typically. Another way to shorthand it when you're looking at it is usually about 1% to 2% higher than conventional mortgage rates. So if you can get a conventional mortgage rate for 5.8 or 5.9 at some places, plus 2%, you're going to be in the high 6s to high 7s for your DSCR, and you can get improvements on that, but that's just shorthand. So that's the trade-off. DSCR loans allow you to scale faster and acquire multiple rental properties per year, but you're paying a little bit of a premium on the interest rate. Traditional lending offers you limits you after the few properties like we talked about, and the DSCR just allows you to continue building your portfolio without being restricted by any debt to income limitations on your W-2 income. Now let's talk about something else. Not all DSCR lenders calculate income the same way. Some lenders use the lease agreement rent. Some lenders use market rent from an appraisal. Okay, so then if they're doing that, when you have an appraisal on the property you're planning on buying, it's going to be entirely determined on that person's calculation. And sometimes they're going to be familiar. If you're doing a short-term rental, they may be anchoring it or only able to appraise it to a long-term rental. So that's something we can flesh out more and you can talk to us about for your particular deal, but it's something to keep in mind. A lot of lenders are going to use the appraisal method and be anchoring to long-term rental, even if your intentions are different with medium-term, short-term rental or otherwise. Some lenders use internal DSCR calculation as well. So short-term rental financing may be projected with different revenue models like AirDNA or their internal statistics. Again, going to be lender specific. So that's something you want to discuss with them. If you are uncertain or looking for a referral to help get your deal done, again, just sign up with us and reply to the email you get automated from us at dscrdepot.com. So this means the same property can qualify at one lender and be denied at another. If you do not match the deal to the correct lending structure, the deal can collapse even if the property cash flows. So a lot of people might apply to a particular lender, not get the result they want, and give up and think it's not for them. Okay, you want to increase your education, keep learning, and realize that you can get a deal done. You just need to find the right product market fit. Each lender is going to have what's described as a lending box. Okay, and they're only going to fit certain parameters in there, and they're not really going to be able to deviate from that parameter list. And it's important to remember that there's hundreds of different lenders out there because these are essentially business loans. It's not a conventional mortgage. This is a small business that you're intending to run with the DSCR loan structure. So each lender is going to have its own box, and you just need to find the right fit for your business and what you're trying to accomplish and line it up with the lender. Okay, and that's very doable, but there are so many different options, it can be overwhelming. So it's important to just continue to learn and understand this and make sure you understand everything before you jump into a deal. So here's an example. Investor expects $3,200 per month in Airbnb income. Okay, so on a short-term rental. And the lender only allows $2,100 based on a market rent appraisal. That could be very typical, where you feel like you fleshed out in a plan on a short-term rental, either Airbnb or otherwise, or maybe corporate housing or some other strategy, but they're going to be anchoring it to a long-term rental appraisal. So all that means is you need to find a short-term focused lender. And again, talk to us, see if we can make an introduction to you or strategize on your particular deal, but that's what you want to search for. So that just means the DSCR falls below that requirement. It doesn't mean the deal can't get done. It just means you need to find the lender with the right box. So to prevent situations like this, you have to know the lender will calculate rental income before submitting the loan and wasting your time. So that's something you can ask any broker you talk to or any direct lender. And that's one of the most important lessons in DSCR financing is knowing how they're going to make that calculation. You can also inquire what appraiser they use and how they typically make their calculations and do some online research with that. We can go into more detail in other videos about the appraising process and some of the mechanics of that and some of the things to look out for, because that can be tricky as well, especially how some lenders integrate and interact with the appraising company. So strategy, let's just throw another example. The ideal DSCR range is somewhere in this area, 1.1 to 1.35. Now, it doesn't mean you can't get deals done under one. There are lenders that go down, lower, especially under special circumstances, with particular deals, and other mitigating factors. But when you're closing, when you're searching for a brand new deal, you want to really just anchor it to one, and ideally higher, but depending on your goals. If you need it to be profitable, then that's something you need to focus on. If you're looking to hold a property long term and are comfortable breaking even, or having another strategy, or you plan to get into a property and then refinance in the future, maybe 1-to-1 ratio is fine. And you can improve your DSCR by just adjusting parts of the deal. Pretty simple. Okay, so you can improve it by increasing your down payment. That's going to increase your ratio. Get a lower purchase price. Negotiate a longer term lease. You can potentially build in other fees into the rental price with your tenants. You can convert into a furnished or midterm rental strategy. So all these adjustments can change the income to payment ratio and change the DSCR to make the deal work. So small adjustments can turn a unqualified DSCR into a qualifying one. For instance, like just increasing your credit score, if you have a 680, above, waiting to apply until you have above a 740, can have a significant impact on the rate and get you qualified. So it's important to have your ducks in a row before you, start talking to a lender. So have your down payment and have your credit score in line, and have your understanding of the deal, and then understand what DSCR lenders are ideal for. Business owners. So you're not showing a lot of income, you have deductions, you're not displaying a large W-2 income, although you may have strong cash flow. It's going to be perfect. It's perfect for real estate agents because you also have uneven income. You have commission-based income where at any given time you may or may not have the capital and can't demonstrate consistent income that isn't lumpy from year to year. And then again, just investors with variable income. Short-term rental or Airbnb, people that want to get into that, this is the perfect tool to do that. Also, entrepreneurs who want to build into an LLC with multiple properties. We'll talk about how to use LLCs, how to eventually get your rental properties off your credit report and start building it as into a business structure. The other thing I think that's great, and we'll talk about this in future videos, is that DSCR loans are great for younger generation that's having a hard time finding the W-2 income or making the numbers work. This allows you to save up a 20% down payment and not have to have, a perfect employment or, have strong W-2 income. If you're willing to just buy a property, rent it out, and it begins the ownership chain where you can get into owning a property, even if it's not cash flowing, you get to participate in the inflation that is, not going to stop anytime soon. Okay. So it allows you to at least own a property and participate incrementally. The loan will be paid down. And I think it's a great way for first-time buyers to get into a house, even if they don't own a house that they live in, to just own a piece of property where they don't have to have a particular W-2 income to do so. DSCR loans allow investors to scale without being judged on conventional income. Okay. And like I said, as a first-time buyer, you may not be able to afford a $5,000 a month payment and take on that risk. But what could you do? You could do a $2,000 a month rental property and have a $1,900 mortgage, and over time, incrementally, you're going to pay down the mortgage, the rent's going to increase, and you're going to have control over this asset that is going to appreciate over time. So in 10 years, you may be in a better financial position, and it is just a great way to build equity without going all in with W-2 income on a personal property. So let's walk through how we can help you. So we provide education, and if you want help evaluating your deal, the link is in the description, dscrdepot.com. Just go there, enter your email, reply to our email, and we can start a conversation on how we can be helpful and what introductions might make sense. We also send more strategies and ideas and deals we find online, and we put that on our email list. So just enter your email. You'll receive a short message from us. You reply to that message with your deal details or what you're thinking, and just include the following information: the property link, estimated rent or short-term rental income, your approximate credit score, your available down payment, and we'll review it. And if you want to make an introduction to a lender that we think can be helpful, we'll do that. Otherwise, if we have time, we can share information. So other thing is include your DSCR estimate, your likely rate and loan structure options, and whether the deal qualifies under multiple lender types. So there's no cost for us looking into it. There's no pressure, and just allows clarity for investors beyond just the YouTube channel. So it's just a way to interact with us if it makes sense. If it doesn't, just wait. There's no reason to interact or start a conversation if you're not ready. Just keep learning, keep saving. So the next step is simple. Just click the link in the description, enter your email, reply to the message, and we'll help you evaluate any deals you may be looking at. Thanks for watching, guys. Take care.